The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Happy Freaky Friday, everybody. Live from Studio 2 of Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. and, of course, kicking you off to Super Bowl weekend as well.
Oh, Super Bowl weekend. We are not setting the tone, though, right when it comes to the equity markets. We're right around the lows of the session. There's been a lot of different layers to the market. To the downside, you're now down to lows of the session, 0.9% on the S&P. Tech leading that way to the downside, helped by most of the Magnificent Seven stocks, down by over 1%. The safety trade is the dollar, Scarlett, moving higher. The Bloomberg Dollar Index 10-year yield also up by 4 basis points, but pairing some of those earlier losses.
All right, well, the data show that U.S. job growth is healthy but slowing down, while consumers anticipate a pickup in inflation over the next year. Then you've got tariffs, with President Trump saying he plans to announce reciprocal tariffs next week in the next leg of his trade war. Here's how Chris Verone, who heads up technical and macro strategy at Strategas, sums it all up.
The debate that we're having in every client meeting, is it a hit to growth? Or is it something that restokes inflation down the line?
Add it all up and you've got stocks under pressure. Mega caps getting hit after Amazon gave a disappointing outlook, saying it can't grow faster to keep up with AI demand. But there's unlikely to be relief from the Federal Reserve soon, pushing bonds lower across the curve. And as you mentioned, Alex, giving the dollar a slight lift. Now, speaking of dollars, if there's one place raking in the cash this weekend, it's New Orleans, which is hosting the Super Bowl on Sunday with Kansas City lining up against Philadelphia. Coming up later in the program, we're going to tackle the business of the Super Bowl with deal makers, the president of the Kansas City Chiefs, and the head of the NFL Players Union. But of course, Alex, let's go back to inflation, because that was a big number, especially when it comes to markets and the jobs report and the consumer confidence numbers that people really fixated on.
You know, she didn't ask me about sports. It's so rude. Okay. Well, to that point, I mean, we were having a little bit of a choppy day to begin with, but once we got those UMISH numbers, in particular the one-year inflation expectation numbers, that's when the S&P took a significant leg lower, and we've been trending lower ever since. And this was the chart that rocked the market. This is that one-year inflation expectation, and this is the jump that we saw for that preliminary read in February, up a whopping to 4.3%. That's 100 basis points more than the previous month. Now, if we just take a look over the last few years here, that's the highest that we've seen since 2023, but much higher than we saw back in 2018 during the other tariff issues under President Trump. So clearly that's a worry. Now, you add on things like potential tariffs, President Trump saying that he plans to unveil reciprocal tariffs next week. And then you have things like people buying durable goods now because they're worried the prices are going to increase in the future. And all of that leading to the sentiment and then the weaker equity market.
All right, so put that all together, and we want to get some expert opinion on where things go from here with Diane Swonk, chief economist over at KPMG. Diane, we're twins today because we've got these matching jackets. But nevertheless, I want to ask you about whether investors should focus on that inflation expectations number from the UMISH Consumer Sentiment Survey. Is that more important to this economy right now than another job report which showed the labor market's holding up?
I actually think they're both important, but absolutely. The fact that we're seeing so many consumers so aware of tariffs now and them seen as an inflationary impulse and the desire to buy ahead. Not only are we seeing that from firms as well, we saw a surge in imports from China in December because many firms anticipated that we would see higher tariffs as a result of the election. We were getting the same higher tariffs under the last administration for China, so why wouldn't we expect that? And they bought ahead of that in December. In fact, the shipping rates from Shanghai soared in response to that. But now we're seeing it seep into the 2/3 of the economy that belongs to the U.S. consumer. And that really matters to the Federal Reserve. And the amount that they're jumping is really important as well. This sort of dwarfs anything we saw in the 2018-2019 trade war and underscores how different it is from then after this bout of inflation that we're still fighting at the moment.
So how does that factor into the Fed then? I mean, now it feels like I'm getting more and more economist notes talking about the risk of this year being a hike. BNP Paribas now sees no cuts until mid-2026. You have Morgan Stanley saying they just have that one hike, like one cut this year. Are we in a different environment cycle now?
Absolutely. In fact, we don't have any cuts until mid-2026 either now,
Okay.
and I think that's important. We had just a few weeks ago a couple cuts we thought we'd be able to sneak in. They don't look doable now unless we have something that's similar to the Smoot-Hawley tariffs of the 1930s and you actually have a collapse in the economy and you get deflation. Otherwise, we are in a situation that is slower growth with inflation, which is not the best combination. And it's also making the idea of a soft landing fade away. We've still got strong employment numbers, but you talk about the Fed keeping in what is considered restrictive territory for the next year and a half. That's a long time.
Okay, so soft landing maybe goes away, so that means no landing. I look ahead to next week, Diane, and we've got CPI coming out in the middle of the week. We also have Jay Powell testifying before first the Senate and the House. In terms of what you'll be focusing on, what will you listen for? What is Powell likely to say that could move markets?
Well, I think Powell's going to try not to move markets because this is in between meetings and he'd like to sort of stay out of the headlines at this stage of the game. But we've already seen people like Austin Goolsbee, who is a voter on the committee this year. 4 people rotated into that position. 3 are known hawks. And Austin Goolsbee is sort of the known dove, also talking about not thinking necessarily about a lot of rate cuts this year. That's a big switch for him as well. So I think you're going to see Jay Powell be much more cautious about where the Fed is. They're not going to front run policy. He will underscore we're only going to react to whatever policy comes out. But the bottom line is that policy is out there, and many participants within that FOMC meeting are now pricing in the probability of it and having to think about it in terms of what their next moves will be. He'll be much more cautious on how much he talks about reacting to those things because he doesn't want to react to them until he actually sees policies on the overall U.S. economy and how they affect it.
On the flip side, Bloomberg economist, chief U.S. Economist here, Anna Wong, she actually sees more deterioration in the labor market on both ends of the spectrum, and she sees 75 basis points of cuts still priced in for this year, and that there's a disinflationary pressure from the labor market to the U.S. economy. Walk me through what you might think about that.
So there's possibility if we see, particularly in terms of the number of, if we were to see a massive culling of the federal workforce, along with all the seizures and those nonprofits, contractors, healthcare that are being cut off from federal funding right now, if that were to hit all at once, we could see a spike in unemployment. And that would be more of a Smoot-Hawley kind of situation, not a Great Depression, but a spike in unemployment that's rapid and hard for the economy to absorb. That would be something that would be much harder to be inflationary. Even with tariffs, it still would be worse growth and add insult to injury. But that's why it's important to think about what context and why Fed Chairman Powell will not front run what he thinks the Fed's going to do, even though we think, our scenarios on tariffs suggest that they're going to stay on the sidelines and not cut it all. There is a possibility that you could see the economy weaken given how low the pace of hiring is, how low layoffs are, how low the quit rate is. If you saw a spike in layoffs, that can change that equation on unemployment very rapidly.
Diane, very quickly, one final question to you. Are you concerned about the president's moves to access and remove access or limit access to data at federal agencies? Is that going to compromise the economic data that markets rely on right now?
Absolutely. One of the things that we've worked on for a long time is the quality and the integrity of economic statistics. And I know most people out there don't always trust this, and the erosion in our statistical agencies and our agencies in general in terms of trust has eroded. But this is something I'm on the NABE Statistics Committee through the National Association for Business Economics. I've worked decades on. I've given congressional testimony on it. And it's really critical to have all the data we have. And as much as people don't like the data, they're transparent. They tell us when they're wrong, they revise it, and they tell us how they did it. That's really important accountability to have with your statistical agencies.
All right, good stuff. Diane Swonk, really appreciate your joining us as always. Have a great weekend. Diane is chief economist over at KPMG. Coming up on the close, beer brands have been sliding after the threat of tariffs rocked several big brands on Monday. We're going to talk about whether Super Bowl sales can perhaps bring the fizz back to the sector.
All right, speaking of the Super Bowl, we discussed the asset class of sports and how institutional investors are increasing their exposure to score big with Dave Dase. He's a global co-head of sports with Goldman Sachs.
And keeping with that theme, like we told you at the start of the show, everything after the market close will be a drumbeat to the big game on Sunday. We've got a huge lineup of guests, including the president of the Kansas City Chiefs, the CEO of Tubi TV, where you can watch the game this weekend if you don't subscribe to cable, and New England Patriots owner Robert Kraft. All that and more coming up. This is The Close on Bloomberg.
Amazon seeing a steep fall after warning investors in their earnings that they could face capacity constraints in their cloud computing division despite investing $100 billion this year. That echoes concerns of rival Microsoft, who also said cloud sales growth was hurt by lack of data centers to handle AI demand. Overall, Mag 7 struggling as well. Our next guest says the big tech earnings over the past 2 weeks have not helped to justify the sector's elevated valuations. That guest, David Bahnsen. He's chief investment officer at the Bahnsen Group. Is this the rotation we've been waiting for?
There's been some pump fakes along the way on that rotation, so I'm hesitant to call it. But I also would point out that usually rotations come incrementally, and NVIDIA is down 26% from its high, and no one was talking about it. On those really big bad days, they talk about it, but it's incrementally refused to go make new highs. And NVIDIA is the one that I think is most vulnerable because not just the valuation, but fundamentally the assumption of ongoing capex infinity at margins infinity has always been an absurd assumption.
Yeah, and NVIDIA, of course, not reporting until the end of this month, about 3 weeks from now. So what do we learn from the big tech earnings, the Mag 6 that did report? Everyone says that they were good. They, for the most part, did deliver or in many cases beat estimates, but not by the margins that people want to see given the valuations.
That's right. So earnings estimates are not really the issue there. It's revenues and then forward guidance, and really almost all of them had some negative attachment to it. And not in a bad market, in a good market where these are sort of becoming laggards. So again, it's a little early, but if someone had told me S&P is going to be up 3% through the first 5 weeks of the year and 6 of the 7 Mag 7 names are going to be down, I wouldn't have believed it.
But.
That's
and you got
are.
Meta. I mean, Meta's at a record high. That's a totally different story than, say, what we've seen with Amazon. Even Amazon was at a record high, close to when it reported earnings, right? So are we being a little too harsh here? Well,
I'm not being harsh because it's one name that I don't think they have ever been monolithic. I mean, Mag 7, we made it up. We talked that way for simplicity. Last year, it was Tesla. 6 of them were up. Tesla was down big till the end of the year. But they're not necessarily connected in any way. They have totally different businesses, totally different business models. You're right. Meta's the one up this year. But when you look at NVIDIA, Apple was down 11% at one point. I think it's only down 8 or 9 now. Microsoft has its story. So no, that as a group, those names are vulnerable. And as a group, those names are almost 40% of the S&P, and they're 55% of the Russell 1000 growth.
And, the catalyst for all of this was DeepSeek, the revelation that you can make AI models cheaper and more efficiently than what we've seen so far. Was that a fundamental catalyst for re-rating the sector and everything tied to AI, or was that just an excuse because valuations were pretty lofty?
It's both. And so I think it was a new catalyst, but NVIDIA had already been struggling a bit. And then I think DeepSeek represented either a real catalyst or at least the indicator that it's out there, that the CapEx assumptions in AI are not justifiable and they're not explainable. We don't know what ROI people are getting from this monumental expenditure. Just the mere vulnerability that it may not be necessary called the whole story into question.
Taking a look at the market, I should point out the S&P is now down by 1%. So it's not just tech. Yes, it's discretionary and tech are leading the way down, but then you got materials, you got communication services, you got financials, you got the cyclicals because we have this tariff risk, right? Where do you go for safety?
Well, again, we're talking about one day here where market is up 3 or 4% on the year. And by the way, communication services is tech. That to me is the funniest story of how incredibly correlated those two groups are. And right now, look at what has worked this year. A lot of energy names, even with the energy sector not. And the healthcare side, which had been sort of a laggard last year. A lot of people were emailing me early in the year, you're worried about RFK because we have exposure to some of these dividend growers. Some of those names are doing very well, but it's very bottom up, out of earnings season. You had Merck Merck had a really tough result. Other names had a good result. But there are plenty of names doing very well. It's just not Mag 7 carrying the market right now.
You know, it's notable that financials are the best performing group, and for the most part, they're not going to be affected by tariffs or the threats of tariffs or tariffs coming on and then being taken off. You noted something when you came on set earlier, which is that time flies when you're faking tariffs.
Yeah.
How is this going to play out over time? Because we're now in a news cycle where it could be imposed, it could be removed within 24 hours.
Yeah, well, and imposed and never actually imposed. I mean, the threat of imposition. And so market actors have learned for the most part. You know, people are talking about the futures are down 600 points. Even 600 isn't that much. The market had been up 600 10 days before that. The market would be down a lot more than 600 points if we were really putting unilateral 25% tariffs on two of our biggest trading partners, the three countries together representing 43% of all U.S. imports. The whole point is markets don't believe it. Why our counterparties believe it, why he's able to extract at least cosmetic, if not substantive concessions. I've given up on trying to question his ability to negotiate. He's clearly better at it than I am, but I don't think that the tariffs are coming, and I don't think markets believe they're coming. And so right now that leaves us back to looking at economic fundamentals, earnings stories, CapEx, other things that matter. The tariff thing adds volatility, it adds vulnerability, but I don't think it's a substantive fundamental concern.
U.S. exceptionalism trade, does that still live then?
In the sense of trying to use it to protect domestic manufacturers?
No, just in terms of like buy stocks, you short bonds, you buy the dollar.
Oh, yeah. I mean, right now, I think that the whole issue with the dollar is just whether or not it's already long in the tooth. But this idea that President Trump wants a weaker dollar, most of the things happening reinforce a stronger dollar. But yeah, I mean, as far as risk assets, where else on the globe are opportunities better? I would still say from an earnings environment, macroeconomic, it's still U.S. I just don't think people should do it in cap-weighted indexes. I think that's the part that is overvalued, and you have to be a bit more selective bottom up.
All right. And to your point, the dollar is higher today by 0.2%. David Bahnsen, Chief Investment Officer with the Bahnsen Group. Thank you so much. Now, coming up on the close, food and beverage sales could rise to a whopping $9.4 billion before Sunday's big game. We're going to dive deeper into how the industry can win big with the consumer. This is The Close on Bloomberg. Time now for our top calls and look at some of the big movers on the back of analyst recommendations. And we got to start with Nike, a downgrade to neutral from buy at Citi on the premise that fiscal 2026 is not shaping up to be an inflection year. Following a meeting with the new CEO, Elliott Hill, the analyst says he no longer has the patience or conviction to wait another year for a turnaround on sales or EBIT margin. He also slashed the price target to $72 from $102. Shares currently down about 3.6%.
All right, Scarlett, I'm taking a look at e.l.f. Beauty, the cosmetics company lowering its annual projections for sales and profits due to softer than anticipated January trends. This spurred a few downgrades, including a cut to neutral from buy at D.A. Davidson. The analyst still views e.l.f. as a best-in-class company, but she just can't shake off her concerns about tariffs and higher promotional levels. Those shares are just getting whipsawed here, down by about 20%.
All right, and let's end things on Denny's. Shares of the breakfast chain are sunny side up after Wedbush raised its rating to outperform from neutral. Kiki's Breakfast Cafe was the star of this call, with the analysts calling the chain meaningfully undervalued and underappreciated. He also expects same-store sales at both Denny's and Kiki's to exceed expectations this year. Denny's reports earnings next week, and the shares right now defying the market decline, up 7%. And those are our top calls. Now we're going to stick with food and beverages because millions of football fans will be tuning into the Super Bowl on Sunday. And what good is Super Bowl Sunday without wings, chips, soda, and alcohol? Viewers are expected to shell out more than $18 billion on those items to make their big game celebrations a touchdown. Joining us now for more on this is Filippo Falorni. He is lead analyst covering U.S. beverages, household products, and personal care over at Citi. How big a boost is a one-day event like the Super Bowl for some of these companies, Filippo?
Hi, Scarlett. Thanks for having me on. Yeah, look, the Super Bowl is always a very important event for many of these companies. I wouldn't say just for the consumption in the day of, but much more for the brand building around it. So you see a lot of my companies really focus on commercials around the Super Bowl to really try to get consumers into their brands, and particularly around innovation. That's a really good aspect that a lot of companies are going to highlight in their commercial. But in terms of your consumption, it could drive 1 to 2 points in terms of volume growth for those kind of month of February typically. And so that's an important event also from consumption.
This might be a supremely dumb question, but what kind of beer does well? Is it just, the regular guys? Is it going to be Kraft? Are we talking about more specialty drinks? What's going to drive the needle, move the needle on Sunday?
Yeah, so that's a good question, Alex. So, look, traditional beer, the domestic beers have been on decline over the last 10 years. So what you really see in the U.S. beer category is that you've seen an emergence of, especially the import beer brands from Mexico. So the Constellation brands, the Corona, the Modelo, those have been the fastest growing beers. Obviously, now there's a lot of concern around those beer from the tariffs, the potential tariffs from Mexico. We have a pause for about a month, and then we'll have to see what President Trump decides in early March. And then the other part of the beer category that's really been growing is kind of all these beer alternatives. So before, in the summer of 2020, 2021, was the hard seltzer boom. Then we've seen the hard seltzer really have a boom-bust kind of growth. And then we've seen the growth of all these other alternatives, including flavor malt beverages, brands like Twisted Tea that is manufactured by Boston Beer. And then more recently, all these other alternatives in ready-to-drink alcohol, including Surfside, and then more recently, Sun Cruiser, which is going to be featured by Boston Beer at the Super Bowl as a recent innovation that they launched earlier last year, and then they're going to go national in Q1 of this year.
Oh, so we'll look for that. How much pricing power do these companies have? And I ask that because PepsiCo, in its earnings report, indicated that it is no longer going to cut prices, or it's not going to try to boost sales by cutting prices, I should say, but it will offer more variety in package sizes and maybe provide value through packaging differently the products it has on offer. I mean, do beverage companies have that option?
Yes, look, I think for the salty snacks, it's been a challenge. 2024, we've seen a slowdown in volumes in the category. There's obviously a lot of concern around GLP-1 drugs adoption and the reduction of consumption for consumers that are taking GLP-1 drugs, and generally a more health-conscious consumer. So what Pepsi talked about is, last summer, they tried with a lot of promotional activity. It didn't really work. It didn't really stimulate volume. So for 2025, what their plan is not really focus as much on reducing prices, to your point, and promotions, but really focus on price packs, and so offering different pack sizes to consumers. On the beer side and the beverage side, companies have been doing this for a long time. Coca-Cola kind of started this trend with smaller cans, like the mini cans, the mini bottles. And those have been pretty successful for these companies as they generate higher revenue per same amount of liquid that gets sold.
Hey, Filippo, thanks a lot. That was really interesting. Filippo Falorni over at Citi, thank you very much. But you do Pinot Noir, so what do you do for the Super Bowl? Do you switch to beer?
I'm not going to drink, I think, Sunday night.
She hasn't gotten that far yet. She's still ruminating. All right, fair enough.
Are you? Are you going to watch the game?
Nah, I don't know. My husband makes me. All right, coming up, why more investors are turning to sports. We'll break that down. This is The Close on Bloomberg.
It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. So clearly, Scarlett's getting excited about the Super Bowl. And much like the NFL, Live Golf is closing in on more places for its star golfers and finalizing deals to boost viewership and investment. So Bloomberg caught up with its CEO to discuss his plans for the league's future.
We have the best players from around the world. That's been an experience. Getting ready for this incredible event season, kicking off in Riyadh, and getting our feet under us and planning for the future.
Now, I know you're not in position to give us the contours of the deal, but is it your expectation that if a deal does come to fruition, that it would allow for more coexistence between LIV players and the PGA Tour? Is it your expectation that ultimately LIV players could participate in the PGA Tour without being penalized?
You know, our focus right now is on making sure we take the best players in the world to the best locations in the world. It's a deal and a construct that we've all been working on for some time, and we're all focused on the same goals and objectives, and that is to grow this game, put as many of the greatest players on the biggest stages of the world. And while I'd love to walk chapter and verse into the deal, I will tell you that anything that's good for this game is good for LIV, and we're thrilled that there's progress being made.
And that progress is being felt across all sports leagues looking to raise the valuations of their respective organizations. Joining us now for more on the business of sports investing is Dase. Dave is Global Co-Head of Sports and Head of Investment Banking Southeast Region for Goldman Sachs. Dave, a pleasure to speak with you. I just want to get your quick opinion here on golf. What is the appetite for moving the LIV Golf PGA Tour merger, which was first agreed upon back in 2023, to completion? Is this something that we might see in 2025 or like 2027?
Thanks, Scarlett. I think I'm not going to speculate on any specific deal, but I think Scott articulated it very, very well, which is the game of golf is better when you have the best players in the world competing against each other more often on some of the more prominent courses and certainly in the largest tournaments. And so I think that would be a good thing if they're able to bring it together, and that's what the fans certainly would want to see.
All right, well, let's stay with deals here because the Super Bowl is a game, but the days leading up to it is when the networking really happens. You've got former players, team executives, owners of teams of sports that aren't even playing in this game, all in town, all networking with each other. Can you describe the deal-making environment that takes place during Super Bowl week? I know you're going to head over to New Orleans after speaking with us. Is it like a Sun Valley for sports?
Look, it's an enormous opportunity to get together, get the most important people in the world of sports together. You get to see a lot of people. I'm not sure from a deal-making activity. Sure, there's probably some conversation which is going on, but in terms of cutting deals, I just don't know. But it's an amazing opportunity to get together, see a lot of people, and build out your network. And I think more importantly, have a real impact in terms of thoughtful discussions about driving the world of sports forward.
There's so much conversation now about investing in sports, from big name investors to private equity to big investment banks. How's the competition right now?
Look, I think as you go back over the last multiple decades, right, the ability to get access to investing in this asset class has been really, really limited. That started to open up over the last 3 or 4 years. And why has that opened up and why is there such a desire? It's really because the returns in the sports world have been really, really strong. They've generally been uncorrelated to other asset classes. And so it's not surprising that external capital would like to have access to these types of investments. And so I think we'll continue to see more of that. We've certainly seen that across multiple leagues over the last 3 or 4 years as they've opened up ownership requirements or the ability for institutional capital to come in and invest. We've seen it in the NFL over the course of the last several months after many years of deliberating on it. We saw a few deals done in the NFL last year. Some of those were, quite frankly, kind of typical, old school deals where it was individual investors who came in. A couple were done with institutional capital, and I'd expect we'd see that environment going forward into 2025.
Clearly, the economics of sports is evolving. You look at live sports rights, and they just keep going higher and higher, and media companies really can't afford not to be part of it, and we're seeing that with the streamers getting in on the action, too. How much of this the live sports rights, the media rights, is driving rising team valuations, not just in the established sports leagues like the NBA or the NFL, but also in nichier sports as well?
Yeah, look, I think it's critically important. You articulated the traditional broadcasters, the digital media players coming in real size. But let's go back. This is a content discussion, right? The largest leagues have the most interesting content, irreplaceable content. It's the content that the broadcasters and the brands who are advertising around it, the digital media companies certainly understand, and they understand that value. And so it's really driving the valuation from a perspective because the content, the ability to aggregate a live audience, Super Bowl is the biggest event in the world where you can really, truly aggregate a live audience, which is very, very difficult to do today in any context. But sports has the ability to do that, and that's why it's so attractive, and that's why valuations continue to tick higher.
There's live content. Of course, there's also adjacent content like biodocs that a lot of the streamers produce as well. At what point, though, does that become too much and we're going to start to see a top form in the cost of producing that and the cost of airing that?
Yeah, look, I mean, interesting stories are interesting stories. You guys tell them all the time. And so I think there's enormous appetite for that. Certainly, again, these are investments. It's big dollars which are going into this. So investors have to look at this from a fundamental return perspective. And I think the content creators have to think about the monetization of that model as well. And so as you articulated, it's incredibly competitive out there. And so the ones who are able to create that best-in-class content, I think will be able to drive nice returns. And the ones who are not able to create that types of content, it'll be more difficult for.
Dave, when I hear about a rush of money coming in and really being good investment and valuations going up and liquidity, et cetera, I get worried about a bubble. Why shouldn't I be?
Yeah, I mean, it's interesting because valuations have certainly moved. But I think you look at where the NFL got their media rights deal done. I think you got where the NBA was able to get their media rights deal done. These are really true businesses today, right? So not only are they have upside from their core properties, I think there's real operational upside. We really haven't touched on direct to consumer yet in terms of the operating model and what these teams, these leagues are going to be able to do from that perspective. We talked about the opening up of institutional capital coming in. Many of the leagues still have restrictions in terms of loan to value and how you capitalize these teams and how you capitalize the leagues. I think those rules over time may see some relaxation. So there may be a cost of capital opportunity as well in terms of driving that down, which should help drive up values. And then ultimately, certainly from a team perspective, the scarcity value. You only have so many of these. You have expansion periodically, but you only have so many of these in teams, and it's part of being a club. And so these are really, really unique, differentiated assets.
Okay, there's a ton of questions I could follow up on, but you mentioned how institutional money is coming in and individual investors who are wealthy can come into these teams. But for the most part, pro sports teams are privately held. You've got some exceptions like the Atlanta Braves or MSG Sports, but individual investors don't have access to maybe getting a piece of the team. Do you see anything changing that, Dave?
I do. I mean, you've seen incrementally, right? We really think of sports as a true asset class. I mean, it is a massive asset class if you think about the valuation of all the teams and all the ancillary businesses around that. We think of three different buckets. You have the teams and the leagues. You have what we call sports adjacencies, right, which is gaming, ticketing, data analytics, apparel, et cetera, those types of businesses. And then the infrastructure business, which is the stadium business. And, these stadiums now cost multiple billions of dollars. Arenas cost billions of dollars. And so we think there's huge investment opportunity in all three of those different buckets. Institutional capital is definitely looking at it. I think over time, as we've seen with other asset classes, you'll start to see more of a democratization, right, of this. There have been a couple funds set up that are set up to raise capital from high net worth individuals that just buy LP stakes in teams. And so I think you'll continue to see progress on this in line with what we've seen in some of the other asset classes over the course of the last 10 or 15 years.
All right, Dave, thank you so much for joining us today. Dave Dase at Goldman Sachs. He's the global co-head of sports and head of investment banking in the Southeast region. Now, coming up on the close, we're looking at shares of U.S. Steel under pressure after President Trump signaled that Nippon Steel is considering a U.S. Steel investment, but not a purchase. That is our stock of the hour. This is Bloomberg.
Nissan's going to be doing something very exciting about U.S. Steel. They'll be looking at an investment rather than a purchase. We didn't like the idea. U.S. Steel is a very important company to us. They've agreed to invest heavily in U.S. Steel as opposed to own it, and that sounds very exciting. And
that was, of course, President Trump. He meant to say Nippon Steel, indicating that that company is considering investing in U.S. Steel instead of an outright purchase of the company. And these comments came during a joint press conference with the Japanese Prime Minister today. U.S. Steel shares currently down more than 6%. So we needed to bring Bloomberg's Joe Doe in here. It had fallen as much as 10.5%, but earlier it had gained as much as 5.4%. What happened today?
Well, we initially had the president come out and say in a small press conference that his mind had not been changed, that he still did not support U.S. Steel being bought by Nippon Steel. This is a stance that he's had since last January, before he was even elected president of the United States. Shortly after the words, there was a report that came out. I mean, minutes later, there was a report that came out and said the president actually might be open to some sort of deal. And then the press conference that we just showed was him saying Nippon is going to make some sort of investment in United States Steel, but they're not going to purchase them. So the shares are now down 6%. largely because investors are saying, okay, an investment in U.S. Steel, that means I'm not getting my $55 per share offer of the original deal.
Because for context, like, it's not like U.S. Steel is going bankrupt without an investment from Nippon, or it needed to buy it because or else it would tank. That's not the point.
Right.
The point was it was a deal for shareholders and they liked $55 a share. So now what? Like, where's going to be the bottom now for these guys?
I mean, that's a great question. In fact, I was talking to one investor shortly before this who said, well, I guess we're going to have to find some sort of new bottom. You know, does that keep the bottom higher than people initially expected or not? I mean, the question is, like, what is this investment that Donald Trump is talking about? The companies have not said anything. U.S. Steel has not said anything yet. Nippon Steel has not said anything yet. They've not been available for comment. I wonder if they're trying to figure out what this might be. Of course, many of our viewers and readers might remember that we reported yesterday, Dave Burritt, the CEO of U.S. Steel, met with Donald Trump at the White House yesterday. It's still not clear what happened in that meeting. I think there's a lot up in the air. And the question between investors and others who are watching this market is, what's going on? Right now, obviously, with the way the stock is moving, it's what's going on is not a very comfortable feeling.
Yeah. What do the Steelworkers Union want?
Well, I mean, the steelworkers are split. Union leadership do not want this deal. They feel like there are not enough guardrails in place for it to be a good deal long term. I was talking yesterday and this morning to a couple of steelworkers who do want the deal to go through. So that tension remains. It's a lot. And listen, these steelworkers themselves have admitted they're exhausted. They have been through it for the past year. Going to be bought or not bought. At some point, they want some closure.
And union leadership would probably say they're all united when they're maybe not. And there's also some discontent in that, too. All right, Joe, you're the best. Thanks a lot. Bloomberg's Joe Deaux joining us there. All right, coming up, we're 15 minutes away from the closing bell. It's been a pretty weird trading day for the S&P. We're going to take you right to the bell, how to set yourself up for potential risk. This is Bloomberg.
We don't have any cuts until mid-2026 either now, and I think that's important. We had just a few weeks ago a couple cuts we thought we'd be able to sneak in. They don't look doable now unless we have something that's similar to the Smoot-Hawley tariffs of the 1930s and you actually have a collapse in the economy and you get deflation. Otherwise, we are in a situation that is slower growth with inflation, which is not the best combination, and it's also making the idea of a soft landing fade away.
That was Diane Swonk, chief economist over at KPMG, kicking off the show, and it really resonates with the idea that we're back to looking at data points because who knows with tariffs.
Well, also just the calls of no cuts, and then the question of, oh, do we get hikes? Question mark. Taking a look at the market here, the S&P is down by 0.9%, right around the lows of the session, Scarlett, but still really big tech is underperforming, but small caps are getting hurt as well, and Tesla's just having a really tough time of it. I mean, down. It's like this worst week for Tesla in quite a long time. I have the notes. Worst week since October, falling for 3 straight weeks.
Before the election.
Worst level today since early December. And I point that out because that was really a proxy for Musk in terms of Trump. And now that's really reversed, which is quite interesting.
Absolutely. And in fact, for the week, we have the Dow, the S&P, and the NASDAQ all down, albeit by about 0.5%, but they are going to record a lower week. So for more market analysis, we want to welcome now David Sowerby. David is Managing Director and Portfolio Manager with Ancora Advisors. David, did we get any clarity with the latest jobs report, with the consumer sentiment numbers out of University of Michigan that helps us understand how to approach this market better?
Scarlett, I think generally positive. Maybe the jobs number was less than expected. However, income growing net of inflation 2%, hopefully trending higher. That's good. I think this jobs number and what we're seeing in labor markets leads to more productivity. While the market may not embrace it today, over the intermediate, longer term time period, I think this is more beneficial to corporate America and the terrific corporate performance we've been experiencing in profit and free cash flow margins, I think generally to the positive side.
But what's interesting is that if we get no cuts, doesn't that change the market function? I mean, that's a very different kind of setup for the market.
Alex, it does on the margin. However, 10-year Treasury yields knowing that the Fed may not be cutting this year, have gone lower, probably out of agreement that inflation still needs to be closer to 2% than 3%. So a 10-year Treasury yields 4.5% today. On a relative valuation basis, in large cap and small cap portfolios, I can find companies that are generating free cash flow yields of 5%. That compares quite favorably to the 4.5% yield on a 10-year Treasury. I don't think that's going to get in the way of being able to find good companies.
So where are you finding these good companies? I know it's a bottoms-up approach. You're going to have to look at everything line by line, but what commonalities do they share? Are they in certain sectors? Are they shielded from international headwinds?
Well, always pay heed to the macro, but if you add your greatest value on focusing on the micro, I think it's both in large cap and small cap, leaning a little bit to the value side. Despite the ups and downs, value has outperformed growth since that inflection point last July of 2024, outperforming year to date. So if you can find companies that are generating free cash flow margin of better than 12%, the average is closer to 9%, that sets the good backdrop. I enjoyed your previous guest who talked about sports franchises. So I'll bring you the Atlanta Braves, which is the famous John Malone spinoff. Spinoff stocks are quite compelling over the longer term. Malone is in there, again, buying. Sports valuations are heading higher. It's not just the ticket sales, but it's the broadcasting rights. In the case of the Atlanta Braves, it's the mixed real estate around the stadium. And there's only 4 analysts who follow it because it's more to the small cap side. I think there's a good name on the small cap side to pair up with some large cap stocks.
Hey, David, I was interested in sort of the movement in the S&P. A lot of them are home builders, in part because if rates don't go lower, does that wind up hurting? But also, so lower rates is going to hurt their business. Plus, if you have tariffs and lumber, maybe an issue. Do you play this market at all?
I do 2 ways. Weyerhaeuser is the REIT lumber timber play. Lumber prices since mid-December are up 12%. Commodity prices are, fortunately, after a long-term hiatus, back on the rise. So Weyerhaeuser is going to double my all-important free cash flow metric this year when lumber prices are going higher and the valuation is compelling. You could add in there a big cap name like Home Depot that's going to benefit more and more from the age of the housing industry and more refurb. So there's 2 ways to directly or indirectly benefit from some improvement in housing and commodity prices.
David, what do you avoid?
When I look at asset classes, Scarlett, that are not attractive to me, it's still international equity. They're on sale, but they're perennially on sale all the time, and U.S. markets perpetually beat it as they did again last year. I think that that's still a suspect asset class. Long duration fixed income remains, I think, challenging to me. And then with all respect to all the private equity investors, they'll tell you capital calls are still coming. Distributions are fewer and fewer. The higher interest rates have impacted the private equity industry much more because of their cost of variable rate debt. Those are 3 risks I see, along with the natural risks of tariffs. Just quickly, good things out of the Trump administration on deregulation, taxes, government efficiency. That's 3 steps forward. Tariff talk, that's 1 to 1.5 steps backwards.
And one area that seems to do well is financials in that environment, right? They don't have that tariff exposure, but they have the deregulation and the lower taxes. David, how would you play financials?
I like not just the banks. Sometimes banks are interesting, but tend to be all clustered together. So if you look at the filings in the mutual fund I manage, names like Houlihan Lokey, not very well known, but quite skilled in M&A, restructuring, valuation. They're the leader in all 3 of those silos, as well as we know private credit continues to be in significant demand, and Ares is a holding that has done quite well as private credit demand continues to grow from investment committees, including the investment committees I serve on.
All right, David, thanks a lot. Really appreciate it. Have a great weekend. David
you.
Sowerby, Managing Director and Portfolio Manager with Ancora Advisors. All right, Scarlett, let's take a look at this market here. The question really is, how much risk can you take on into a weekend where you already were getting some threats from the Trump administration in terms of tariffs next week?
Anything could happen this weekend. And we know he's going to be busy on Sunday attending the Super Bowl, but there's plenty of room still to perhaps talk about imposing tariffs or removing things that have been already imposed. Who knows? In any case, all 11 groups in the S&P 500 are lower right now.
Yep, and to raise the question, kind of where is that safe haven? It seems like you have idiosyncratic things like Palantir, for example, Constellation Energy doing really well, Uber doing really well, a lot of those on earnings, but question marks around the home builders. All right, we are moving closer to the closing bell. Full market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Alex Steele and Scarlett Fu in the TV studio helping you to take you through the closing bell. We got a global simulcast. We're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most important, crucial moments of the trading day. Well, that was a rough day for the S&P.
I know, here we are, right, bumping along the bottom. Again, there's like inflation concerns, whether it comes from possible more tariffs out of Washington or whether there's some concerns. We saw that in the consumer sentiment numbers. Concerns about inflation, higher prices among folks out there.
Well, I think if we're talking crucial moments of the trading day, I think 10 a.m. when we got that UMISH sentiment number that came in below expectations. Look, tariffs are starting to weigh on consumer sentiment. That message is clearly getting through to consumers.
Absolutely. I like what David Sowerby just told us. Tax cuts, deregulation, government efficiency, all those things are 3 steps forward. But tariffs are like 1 to 1.5 steps back. And what have we gotten concrete details on, at least a focus on, in the first 2 weeks, 3 weeks of the Trump administration?
2.5 weeks.
2.5 weeks.
Feels like a year.
Yeah, I know. It's been tariffs, right? That's what he's been focused on.
Yeah, the question is, though, is it real or is it a negotiating tactic, right? Like, what's the ask for the other country? Well, I'm taking a look at what we've learned throughout the week in terms of retail buying, right? Mom and pop investors coming in pretty strong on 2 to 3% declines in terms of a buy the dip. Do we see that then coming in on Monday as well?
Yeah, whether or not the enthusiasm continues, right, and helps to prop up kind of the markets here. I guess we'll have to wait and see. I mean, we're still in earnings season. We're not quite done, so maybe that helps or hurts it.
Robinhood reports next week,
All right,
Alex, so
we are wrapping up the Friday here on this trade when it was a kind of a choppy trading session for the S&P. It looks like the S&P is going to close down by about 0.9%. You're around the lows of the session. We're also looking at the NASDAQ off by about 1.3%, the Dow up by 1% as well. Guys, just want to point out the small caps not spared, down over 1%. The Mag 7 also not spared, down by about 2%. The only upside there, NVIDIA and Meta.
All right, guys, looking at the S&P 500, most names in the index, no surprise, lower today, about 364, losing ground on this Friday, 140, Scarlett, to the upside.
And there's a lot of red when you look at the sector performances as well. That's the IMAP for you, all 11 groups in the red. Consumer discretionary off by 2.5%. Of course, that does include Tesla and Amazon. Communication services down 1.2%. Materials off by 1.2%. Your better performers, energy basically unched, and utilities and industrials losing just about 1/3 of 1%.
Wow, that's a really clear chart. For those on radio, it's all red, the IMAP here at
Good luck
Bloomberg.
with gainers.
I got a few.
Okay.
Uber, folks, finishing off its highs of the session was up more than 9% at its highs today, but finishing the day with about a 6.5% gain. So it was among the top gainers that we saw certainly in the trade today. News, Bill Ackman, his hedge fund, Pershing Square Capital, owning 30.3 million shares of Uber. I
like that. Let's call it that.
Uber. Okay. Oh, my God. Uber. It's so Friday. So we're talking about, based on Thursday's close, let's try and get it straight, owning a little over 1% of the company's market valuation, basically thinking it's well-managed or one of the best businesses in the world, but definitely undervalued. One more name for you, Take-Two Interactive, guys. This is among your top gainers, number one in the NASDAQ 100, top gainer in the S&P 500, 14% higher in today's session. The company reported earnings after the close yesterday, full-year net bookings guidance, and reiterated its plan to launch the highly anticipated Grand Theft Auto 6 in fall of 2025. Anyway, that was enough to push this one higher.
Okay, you got the gainers. I got the decliners. No shortage to choose from. I did want to go with Amazon, though, dragging the S&P 500 and NASDAQ 100 lower, falling 4%. The company did warn of capacity constraints in its cloud computing division, AWS, despite plans to invest $100 billion this year. Andy Jassy said growth will be, quote, lumpy due to challenges securing sufficient hardware and electricity, and that power capacity and chip supply are limiting the ability to bring new data centers online. AWS revenue did jump 19%, but Jassy's warning on those growth constraints overshadowed that fairly strong holiday quarter. And then Newell Brands, it's the parent company of Rubbermaid, Yankee Candle, Sharpie, Mr. Coffee, Elmer's Glue, and many more, down 26% today.
Nice little mix.
A
Yeah.
lot of companies.
Yeah.
At one point, shares fell the most ever in a single day. At the close, though, the worst day going back to 2017. Newell Brands issued a disappointing preliminary annual outlook, projecting a steeper than anticipated decline in full-year sales.
Yeah, taking a look, also just guys, Arnold mentioned Tesla, down 11% this week, the worst week since October, I know, right? I'm taking a look at the bond market. Stuff did happen there. It was actually quite an interesting trade. Sell-off all across the curve, though. We're obviously off the lows of the session. A couple things to point out is that next week we get 3 10s and 30-year auctions, well over $100 billion worth of supply coming online. Also, 4.5 is what many investors are watching with that 10-year yield. If we break above that, do we make a run to 5? So there's some technical stuff going on here as well, guys.
Yeah, we also get some inflation reads next week, right? CPI, PPI. We also get retail sales on inflation day, on Valentine's Day. Okay. It could be inflation.
It might feel like inflation day, yeah.
Right? If you're trying to buy flowers, they're pretty
or
expensive
chocolate,
right now.
guys.
Well, can you imagine a card?
Chocolate.
The only thing inflated is my love for you.
Oh, please, no.
Pretty good, right?
No, it's bad. Don't say that.
Okay.
Just buy the chocolate.
Why was there so much silence?
Our producers liked it. Our producers liked it.
Finley
Yeah,
is
but
the
our
only
producer's
person
not
who
married. Don't
acknowledged
do that, Tim.
Come on, Finley, you know better.
Tough crowd. Tough
Yeah,
crowd.
but I think the point is pretty valid. Valentine's Day will be expensive because cocoa prices are high. So, that's the real deal there, guys.
All right, we also got some earnings coming next week. Deere & Company, Molson Coors, Applied Materials, Coinbase, and then Robinhood Markets. So, Alex, maybe we'll get a read on the retail investor from Robinhood.
All right, we got to wrap, guys. Do your Valentine's Day shopping. I'm just going to point that out. That does it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, Bloomberg Originals. Alex is heading out for the weekend, maybe to do some Valentine's Day shopping. We on Business Week, though, sticking around as the close continues with a special guest on the big game this weekend, the president of one of the teams playing in the big game. And for that, we toss it back over to you, Scarlett. Take it away.
All right, thank you so much, Carol. It's time now for a special edition of The Close, the business of the Super Bowl. We've got an all-star lineup. We've got Kansas City Chiefs President Mark Donovan, New England Patriots CEO Robert Kraft, FanDuel CEO Amy Howe, among others. And joining me for this entire hour is Bloomberg Originals Chief Correspondent Jason Kelly, host of The Deal with Alex Rodriguez and Jason Kelly. Great to have you here.
Hi.
It's fantastic.
What a Friday.
I know.
I mean, the Friday to do this, right?
I'm imagining there's a lot of deal making going on in New Orleans right now with everyone from the sports industry gathering.
Everyone is there. I mean, everyone except us because, we're working for a living. But actually, they are doing deals. I mean, this is when the big deals happen in the sports world because the entire sports world, as you mentioned, sort of descends. Maybe they don't stay for the game, but they're at the parties, they're going to the conferences, they're doing the side meetings. It's amazing. We're going to check in with Randall Williams, who's on the ground.
So
part
much
of our
to talk
team
about.
there. A ton to talk about.
All right, so mind meld there for everyone in New Orleans. In the meantime, let's get straight to someone who's been living the business of the Super Bowl since 2020. He is Kansas City Chiefs President Mark Donovan. Mark, welcome to the program and congratulations on your 5th trip to the big show in 6 years.
Thank you. I appreciate that. Great to be with you guys.
So as the organization makes a run to become the first 3-peat Super Bowl champions, would you say you're more or less nervous this time around?
I think experience is a great teacher. So we've done this enough to realize sort of what makes it successful. We tweak things every year, but it's been a really smooth operation since we landed on Sunday night and started practicing this week, and it's going very, very well.
It's going very, very well. I want to talk about the Chiefs as a brand because it's so much more than a regional team or even an American team at this point, right? It is a global brand that really resonates with sports fans around the world. Talk a little bit about your organization's international efforts and how you have a new entertainment production studio that plays into that really amplifies that.
Yeah, it's a convergence of the platform that we're on right now. I mean, we have one of the most successful franchises in sport. We have the world converging and consuming content like never before. And then the international program that the NFL launched back in 2019 gave us and other franchises the opportunity to aggressively pursue growth internationally. And we've been one of the more aggressive teams to do that. So the convergence of all this on top of being in for the last 6 Super Bowls, and the opportunity to constantly be out there with content is something that we've been very excited about, we've taken advantage of, and we've seen results from. So Foolish Cup Studios is something we launched this past week that gives us the opportunity to create even more ideas and then distribute that content internationally, hopefully.
All right, so Mark, obviously a chance to create more content. Let's be honest, This is Bloomberg. It's a chance to create more revenue when you're this successful on the field. Walk us through what it means to the top line, the bottom line of your team to be consistently in the big game and, now going for your third straight win. What does it do for your business?
Yeah, I think that's a fair question given the audience here today. I think that when you look at our business, we are on a platform we have never been on as a franchise before. And so we look at that as opportunity. What can we do in this platform to take advantage of this time to maximize the platform? So top line, bottom line, it's growing brand value first and foremost, and then everything that sort of comes off of that. And we are very successful in Germany after investing in there over the last 4 years. We're the number one team from brand value in Germany. We have the most revenue from a sponsorship base in Germany. We're looking to do that again and again and again as many times as we can. The opportunity and the platform that I speak of is the international market. So, as we grow, we now have the ability to grow internationally, and that's really the focus.
And so, Mark, part of it is growing the audience, and some of that comes from just showing the games. Also, you mentioned the additional content, but also social media has been especially powerful for you guys. You are one of the most followed teams out there. How do you continue to grow that? And are there certain platforms that are working better for you overall?
Yeah, so it's a combination of things. It's one, the superstars that we have on our team and what they've done with content, with Patrick and with Travis, with his podcast. And it's sort of dovetailing with that and then using the content that we have. We have a program on YouTube called The Franchise, which is an inside look at our team. We're the first National Football League team to have over 1 million subscribers on YouTube. We're the second sports franchise in America behind the Golden State Warriors to do that. So those are the platforms that I'm talking about, that you have to have the content to be able to take advantage of that. So we have a production studio in-house that does the franchise show. Now we've launched a production studio that will be more out-of-house to really look at partnerships around that.
So is it frustrating then with all these plans and this incredible brand, not just in the U.S. but globally, to not have as much certainty as you'd like over where you're going to be playing in terms of stadium down the road?
Yeah, so I would take that two different ways. One, we want to play more games internationally when we're given the opportunity, because we've seen the value of that and we've seen the benefit of that. As it relates to our domestic situation, specifically in Kansas City with our stadium, we are pursuing two different options. One is renovation of the iconic Arrowhead Stadium and GHA Field. And then secondly, investigating the opportunity to build a world-class dome stadium. Two very different paths. And we have the advantage of having two different states that we can go down those paths on. Mm-hmm. I think with, as I said, on the one hand, it's the iconic nature and how can you make a worldwide bucket list icon of a venue better through a renovation versus if we build a brand new state-of-the-art Dome Stadium, we have the opportunity to host even more events. So Super Bowls, Big 12 championships, national championships, as well as year-round concerts and events. So it's an exciting place to be in. I will tell you personally, it's a very time-consuming place because you're looking at a bunch of different options and you're dealing with politicians on both sides of the state line. They're both excited about the opportunity, and we just got to figure out what's the best thing for this franchise and for our fan base for the next generation.
Yeah, it's pursuing lots of different paths and kind of seeing where they take you. I wonder if you would ever look to private equity or sell LP stakes to fund the construction of a new stadium.
Well, we have the expert in the building on the private equity program. Clark Hunt is the chair of our organization. He's also the chair of the finance committee at the National Football League. And he was really one of the architects with, I think, one of your next guests in putting together the private equity situation with the NFL. It gives us the opportunity as franchises to pursue that. Clark has said publicly, and I know in dealing with the siblings and the family members, that that's not something we're pursuing in the present time, but it's good to have the option out there. And we've seen the other teams that have taken advantage of this opportunity.
And so what have you learned from that, Mark? I mean, we have seen a number of your counterparts, one of your arch rivals, the Buffalo Bills, who you beat to get to this game. They took advantage of selling a stake. They may use it most likely to build a new stadium or to upgrade their facilities. What are the learnings that you take, even if you're not going to partake of it right now?
Well, first and foremost, the learnings of seeing them go through the process and seeing just what it takes and how to maximize that process. The second thing I think that this gives you is true valuations. The ability for, the firms that have the ability to capitalize on the private equity piece are true evaluators of value. They have to return to their shareholders. So they're investing in these teams and pieces of these teams in a very structured and a very critical way of exactly what the value is so they can see a return. I think just the first few that have done have been really positive signs for the NFL and for the individual franchises that have taken advantage of that.
All right, so you went exactly where I wanted you to go, Mark, which is valuations. You worked on the league side. You worked for a little team called the Philadelphia Eagles for a few years before you got to your current home in Kansas City. You look at these valuations since you were a guy coming up in this league. I mean, is it mind-blowing to you?
Yeah, it's mind-blowing on the NFL side, but I know the NFL side so well that I can sit here and tell you that the valuations are solid. And you look at the growth of this game and look at the opportunities that are in our future. I'm a big believer, obviously, in the National Football League and the power of the NFL. I think it sort of spreads across sport, though. When you look at the valuations of NWSL and NBA, Major League Baseball, MLS, across the field, as well as, properties like the Premier Lacrosse League. The ability to sort of look at these as true investment opportunities and see the growth that sports provides. There's no better appointment viewing, and frankly, from a rating standpoint, no better viewing than the National Football League. Well, how do other sports match up against that, and then how do they continue to grow that?
Mark, before we let you go, I did want to get your thoughts on one thing. Roger Goodell, the commissioner of the NFL, with the backing of team owners, is standing by the NFL's diversity initiatives, even as we've seen some moves on the federal side otherwise. As the head of a high-profile organization, what are you hearing from your employees, from your customers, from your partners on this front?
Yeah, I think as administrations change, you're going to have change. We're very proud of our policies. We're very proud of what we've implemented at the Kansas City Chiefs. It's something that we take very seriously. I was asked this question multiple times today. And I think, I'd point to even our most recent hire. People talk about and know about the Rooney Rule and all that it's done and the process behind that. I think not everyone is aware of, the impact it has across the entire business. So we just had a very significant hire on our communications team, and we went through a very inclusive and diverse slate of candidates. Mm-hmm. We wanted to see all the talent that was out there before we made our decision. So we're proud of our policies, and we continue to sort of lean on those to have the best possible employee base in the National Football League.
All right, Mark Donovan, a pleasure speaking with you. Good luck to you, president of the Kansas City Chiefs. Mark Donovan. I love the fact that you brought up he was at the Eagles for about 6 seasons before he moved to Kansas City. So maybe, whatever happens, he'll be okay.
Maybe, but I think he's pretty diehard Chiefs at this point. I mean, it is amazing, though, to think about the, part of business is the personnel, right?
Yes.
And so this is a guy who ran the business side. Let's not forget the guy who's running the on-field side for the Kansas City Chiefs.
Yes.
Andy Reid once coached the Philadelphia Eagles. I mean, this is a really tight-knit league. I mean, it's part of what is driving exactly what Mark was talking about there. These massive valuations. These are very smart business people. You and I talk about this all the time. This is a juggernaut. It is a global juggernaut. Amazing to me how much he really leaned into the international side and how aggressive they're being there, right?
Anytime you go abroad, you look at how many people are wearing, say, Kansas City hats or Kansas City jerseys. That's a big part of it. They've got to monetize off of that, tap into that. All right, coming up, the potential for an expanded NFL season.
If we continue to focus on the safety, I think 18 is a potential.
We're going to get the flip side of that with Lloyd Howell Jr., head of the NFL Players Association. This is The Close on Bloomberg.
If we continue to focus on the safety, I think 18 is a potential. And as you know, we would take a preseason game away. So we would keep within that 20-game framework. We actually started at 14 and 6 preseasons. We went to 16 and 4, and now 17 and 3. So 18 and 2 is a logical step, but we would only do that with the players.
That was Roger Goodell, the NFL commissioner, talking with David Rubenstein on the potential for an expanded season. But the NFL Players Association is pushing back. The head of the association, Lloyd Howell Jr., saying no one wants to play an 18th game. I'm pleased now to say we're joined by the man himself, Lloyd Howell Jr. Lloyd, it's good to speak with you, and I know that you just heard the clip we played there. Your members oppose 18 games, yet you heard Roger Goodell speaking about it as if it were a formality. Why do you think that is?
Oh, I think our membership completely appreciates what the opportunity would be for the economics. And given the current all revenue split, on paper, the academics would say, yeah, just keep adding additional games. But where I believe Roger and I do agree is the science has to support the health and welfare of the players instead of just adding more games for financial reasons. And that is still a big question mark. We need to know more about recovery. We need to know what's the proper amount of time, nutritional issues for recovery, as opposed to just adding another game. The other dynamic is what's the complexion of the potential 18 game season. I think the league has had a lot of commentary about wanting to do more international games. In my previous life, traveling around the world, not being a professional football player, it takes a moment to recover. It can be, depending how far away you go, even longer. So it's not just the length of the season, it's also, well, how many games would be overseas and how far away? What's the recovery time? What's the structure of the league look like?
Right.
And then ultimately, what are the finances that would benefit our membership?
So the NFL has announced games in Ireland, in Australia. So far, what has been the players' single biggest concern about international travel? What have you gathered from them?
It comes in different dimensions. There's the sort of logistics of business travel, like size of plane, how large are the seats? Where are we staying once we get to the location? How close or far away is it from the venue? Those are sort of what I would describe business travel issues. But then I think more importantly, it's what's the recovery time? Do I have a bye week after going overseas, or am I expected to play, the next Sunday or Thursday? So there are lots of different dynamics that hang off of just playing overseas, and not the least of which, how many different time zones, and what's that going to look like when I return to home. So in one sense, there are the logistics of travel. In another sense, it's recovery.
Right.
In another sense, it's how do you include the players as a part of any potential expansions the league has an objective around.
Lloyd, I wanted to talk to you about a different aspect of the economics of the NFL. We've had so much talk about new money coming in, institutional capital. We just talked about that with Mark Donovan over at the Kansas City Chiefs. You worked at Goldman Sachs, you worked at Booz Allen. You understand this analysis as well as anyone, the shared economics of this league. What's the best way for the players to continue to be partners and economic partners? Does that entail being equity partners?
It could. I think there are more homework needs to be done. I think rightfully so, there's sensitivity around would this investment create any sort of conflicts of interest? Or would it go through an intermediary where you have an arm's length arrangement where, their capital can be put to use and the integrity of the game isn't compromised in any kind of way? So there are details that need to be worked out, but with the abundance of capital, given the attractiveness of the investment, in your last interview, you highlighted franchise valuations, the valuation of the Shield, it's doing very well. And as a part of that, why not have your workforce participate in that accretion? And I think it makes all the sense in the world for that to be permissible, but the details of it have to be worked out.
So is there a world where you imagine sort of an NFLPA sponsored fund that then, willing players or enthusiastic players could invest into, and then essentially a private equity fund that invests on behalf of the players?
For sure. I mean, there are probably several obvious schemes where that could work. Certainly our membership has more of an equity mindset than ever. Maybe that's due to the introduction of NIL. Maybe that's how they're coming into the league. It's a little bit different than in previous generations. So they themselves appreciate what private equity means. They appreciate what investment means. And they would like the opportunity to participate in that accretion of the game they love and the teams they play for.
I mean, getting equity would go a long way, but we go back to the idea that to really meet the demand, 18 games a season, more international games overseas, all of that takes a physical toll. I'm curious whether there's an idea that, you know, maybe the players need to concede on rosters being expanded. Should each team have more players than what they have right now so that the players' physical health can be spared?
I mean, you're certainly raising dimensions that once, we open up the CBA and we get into it, would need to be put on the table. So when I said, hey, I haven't talked to a player who, wants to play an 18th game, that's in the absence of all these other dimensions that need to be addressed. Recovery, economics, their health and wellness. And we're just not there. So it's just a human reaction that if I say, hey, do you want to do more with no change? And they'll go like, no, I don't want to do that. And so here we are to all the dimensions you put out there that would need to be addressed. And that's just not a snap of the fingers and we get to agreement.
Yeah.
We may never get to agreement just depending on how those other dimensions get adjudicated.
All right, good stuff. Lloyd, really appreciate your joining us today. Thank you so much for the thoughtful responses. Lloyd Howell Jr. is head of the NFL Players Association. Really important questions that need to be asked, and certainly, he has a difficult job of trying to get everyone on consensus.
Well, and what a fascinating moment for these players, right? I mean, the world has really come to them in a lot of ways. They have a fascinating model, I think, in the NBA, where the players really have, I would argue, a stronger voice in really how the league is run.
Yeah.
This is a new head of the, relatively new head of the NFLPA. So interesting. He comes from a Wall Street and a consulting background.
That's true, yes.
Very different from his predecessor, D. Smith. And so interesting to see what the voice looks like. I love the idea of players investing in the league. You see it in other leagues, and the NFL is often the last to come, but when they do, they come big.
That's a great point, but I think they would just as quickly want to get something like guaranteed contracts, which are rarity in the NFL and which are basically default in the NBA and the MLB.
Well, and also really important to remember the NFL, the average career is about 3.5 years. And so the money needs to be there and be there with a certain level of certainty. You're exactly right. And it needs to be there longer term. And so having a longer term investment in the teams or in the league may be that much more important in the NFL.
Absolutely, to both the teams and the players themselves. All right, we've got a lot more coming up here. Still ahead, if you think that having cable or not having cable, I should say, will prevent you from watching the Super Bowl, streaming service Tubi has a solution for you. We're going to speak with the CEO, Anjali Sud, next. This is the Super Bowl edition of The Close on Bloomberg. All right, just some breaking news we want to update you on. Bank of America CEO Brian Moynihan has seen a pay increase by 21% for the year of 2024 to $35 million. So Bank of America CEO Brian Moynihan's pay for 2024 goes up 21% to $35 million. Not much movement in the stock price and after hours trade, but something that we obviously monitor given that we've heard about JP Morgan's Jamie Dimon's pay as well as Morgan Stanley's Ted Pick's pay as well.
Yeah, maybe nicer food at the Moynihan Super Bowl party this year. I don't know. I mean, we'll see.
Yeah, we'll see. I mean, typically, do the bank CEOs go? I mean, it feels like everyone goes.
It feels like everyone goes. I don't know if we see bank CEOs as much. Maybe if they're big fans of either of the teams.
All right. Well, let's check in with our colleague who is at the Super Bowl, who is in New Orleans, because much of the country and the world for that matter, is excited to be at the game or watching the big game on Sunday. For residents of New Orleans, though, it does mean lots of revenue streams will be flowing into the Big Easy. Let's check in with Randall Williams, Bloomberg News U.S. sports business reporter. He is in the city, and he joins us now with a bit more color. We were joking around about whether bank CEOs show up there or not, but you've been there all week, and you've seen kind of the flow and the tide of people coming in. There's also a lot of security on the ground as well, because you had the terrorist attack on New Year's Eve, the reported terrorist attack, or what people are calling terrorist attack, as well as President Trump scheduled to arrive for the big game as well.
Yeah, there is more security than I've ever seen at a Super Bowl. They have the popular streets like Bourbon Street blocked off. There's military vehicles that I only see in movies out on these streets. Like, it's pretty incredible. And, you know, President Trump coming in town is only going to heighten that. The NFL is already preparing for it. It'll be really interesting. I'll probably be walking back to my hotel after the game.
All right, so Randall, I have seen you at these events. You are working the rooms like nobody else out there. You're talking to deal makers.
I appreciate you.
We know how many deals are getting done. Like, what's the chatter? What are people talking about? You've been covering the private equity deals. Like, what's top of mind for the business folks there this week?
Well, you just talked to Lloyd, and I think it was really interesting being at Roger Goodell's press conference on Monday. There's a lot of talk about this 18-game season, 16 international games. And I asked Goodell if he would sell an international package, and he said yes. He even mentioned Netflix by name. So to hear him say 18-game, 16-game international package, then you go to Lloyd Howell's press conference from the NFLPA, and for him to say no one wants an 18-game season. Then I talked to Bijan Robinson, an Atlanta Falcons running back, and he says, you know, I'd love to play 18 games. So there's a lot of thoughts around this 18-game season. It's not collective bargaining time yet, but it sounds like it's going to be a battle, or they're going to need to be Roger Goodell's going to need to do some convincing.
He's going to need to. Okay. Well, we'll of course, look to your reporting to hear what happens there. Randall, your reporting also featured the Super Bowl halftime show, because for a lot of people who aren't football fans, that is where the action is. And
Sure.
Rock Nation, Jay-Z's company, has actually made the halftime show a good thing again, something cool, something to talk about. For a couple of years, it was kind of like an afterthought. People went to the bathroom during the halftime show so they could get ready for the third quarter.
Yeah, Rock Nation took over things, and its cultural relevance is higher than it's ever been. Usher had the most watched halftime show ever. Rihanna had a good halftime show. And so when you think of the Super Bowl and the NFL really now, the most grand event, the Super Bowl, people are tuning in for the artists too, and the artists see that. I think Usher had a 550% increase on Spotify. I'm sure Kendrick will see a similar thing. And the artists are using these platforms to drop music, to make announcements. I think Usher released an album, and Rihanna announced she was pregnant. So we'll see what Kendrick does on Sunday.
All right, good stuff. Bloomberg's Randall Williams, really appreciate you. And of course, we'll catch you back when you're back in New York after the big game.
Absolutely. Thank you for having me.
All right, one of the ways viewers can tune in to watch the big game is through Tubi. The streaming service will be airing the Super Bowl halftime show and ads live and for free. This is a major milestone for the ad-supported streaming service. Joining us now to discuss this is Anjali Sud, the CEO of Tubi. Anjali, good to speak with you. Tell us a little bit more about how this deal came together where you are now airing the Super Bowl for free.
Hi, Scarlett. It's great to be in New Orleans. We're very excited about Sunday. Fox is doing a special takeover of Tubi on game day. Americans will be able to tune in to the game, the pregame show, the halftime show, the trophy ceremony, all free live in 4K through Tubi. And the reason that we're doing this is because we want to broaden and expand the reach of America's biggest sporting event and a cultural moment to many more people. The majority of Tubi's user base, we have nearly 100 million monthly active users. The majority are Gen Z and millennials, and the majority aren't subscribing to cable. So this is just a really great, unique opportunity to bring the game to all of those folks who maybe aren't diehard football fans, maybe are more interested in the commercials and the halftime show. And so we're very excited. We're also going to be doing an exclusive red carpet only on Tubi before the game, where you'll be able to check out the fashion and celebrity around the game and even shop looks from your phone.
Okay, so you are appealing to the cord nevers that may not be diehard sports fans. I'm sure also part of this is to increase your user base. You have about 97 million monthly active users. What do you anticipate that to go to rise to once you stream the Super Bowl?
Look, I think right now our goal is to deliver delight and a great experience to as many Americans as we can. But there's no question, Scarlett, this is a great opportunity to introduce Tubi's value proposition to more of America. Yes, we have nearly 100 million monthly active users, but there are a lot of Americans that don't know that Tubi is 100% free and that we have the world's largest collection of premium movies and TV series. So Our goal is absolutely to introduce more people to that offering, and then ultimately to engage them and have them be watching lots of Tubi in the future.
And so we know that the Super Bowl is, I mean, it's called the big game for a reason. It literally is the most popular thing to consume, to watch on TV. You know, seems like an antiquated thing to say, just to watch. What does this tell us about your future investment and your ongoing investment in sports? This is clearly something that captures everyone's imagination, you know, from the diehard fans to the sort of culturally interested, as you alluded to. So what's the playbook from here for Tubi when it comes to sports?
Well, so Tubi is a free ad-supported streaming service, and what you'll see us do is going to be very different from others. Where we're most interested is how can we tell stories around where sports meets culture, Super Bowl being a great example of sports and culture. But you will see us invest in a lot of other things that sort of do that. Examples include a talk show that we have on Tubi right now with Coach Prime, Deion Sanders, talking more about culture and what's happening in America. We had our highest performing, most watched title on Tubi ever recently. And it's a young adult romance movie about a football player that's based on a Wattpad novel and stars a TikTok influencer. So you'll just see Tubi do more and more around sports meets culture storytelling versus the premium live sports rights, just given that those are very expensive and competitive, as we all know.
And as you think about doing more in sports, are there things that you do less of in order to make room for sports?
No, I think, the reality is Tubi has incredible momentum. We've been growing really quickly, and we continue to invest and do more around the types of content that we put out there. And in general, I think you'll see us we'll look to do things differently. We'll try new things. But really what's driving that is what are our fans telling us? And again, those fans tend to be cordless. They're younger. They're more diverse. And their tastes are a little bit different, and they're evolving at the speed of TikTok. So I think you'll just see a lot more of trying to have a pulse on what's culturally relevant and then trying to deliver that through the content that we offer.
Anjali, really appreciate your joining us. Anjali Sud is CEO of Tubi, which will be streaming the Super Bowl for free, the ad-based streaming service on Sunday. And of course, Tubi is owned by Fox, so it makes sense that they'd be partnering on this. The question is, will the infrastructure be able to handle it? Will it be like Netflix and the Tyson-Paul match?
Yeah, I mean, this is the big question for these streaming services is, like, can they handle, a huge, massive event like this? I'm fascinated to see who tunes in and then who sticks around to Tubi, right?
Absolutely.
What's the conversion rate where you're like, oh yeah, I sort of like this. I like this take on sports.
Yeah, it's going to be my go-to place now. All right, it's not just the big game itself. One of the biggest draws of the Super Bowl are the television ads that air, often starring celebrities. Now, one of those ad campaigns is backed by the Foundation to Combat Anti-Semitism, with former quarterback Tom Brady and rapper Snoop Dogg leading the charge. Their message for viewers is pretty simple. Let's unite against hate in all its forms. Here's part of our conversation with New England Patriots owner Robert Kraft, who is founder of the Foundation to Combat Anti-Semitism.
The American people are great people. We found 80% of Americans don't understand what's going on in terms of hate building up in this country, and it's doing it like it's never done before in my lifetime. And why people would hate someone because how they worship God or what their political feelings are or what their skin color is. Our families all came to this country and were able to live the dream because of the way we accepted everything in America. And I think there's been a growth of hate. Last year at the Super Bowl, we had Dr. Clarence Jones, who wrote Martin Luther King's I Have a Dream speech, speak. And his basic message was that silence from people who see inappropriate behavior is the worst enemy of Americans. And we preach that message, and now we're asking people to reevaluate why they hate. We're born with empathy and love, and hate is learned. And it's so dysfunctional to what's great for America. You know, in 2019, I started this foundation because after seeing Charlottesville and the Tree of Life, I saw signs of what was going on in Germany in the 30s.
Yeah.
And I didn't want a repeat of the 40s.
The two folks featured in that ad, one, Tom Brady, of course, who you have a long-standing relationship with, and Snoop Dogg, of course, who has a long-standing relationship with Tom Brady. What was their reaction when you approached them about doing this ad?
Well, you probably wouldn't believe it, but I've had a relationship with Snoop for 30 years. And, you know, when I called him, you know, he just said, hey, brother, I'm in for preaching love, whatever we can do to stop this hate, count me in 100%. And that really, you know, people wouldn't think we have that connection and have worked together on other things. And then, of course, Tom Brady is one of a kind in his field and so special and unique and one of the greatest human beings on the planet. And for him to be willing to speak out as well. And he liked the idea of the two of them from different backgrounds speaking about what was good for the American people and all people.
Absolutely. Robert, I'm curious how you plan to measure the effectiveness of this ad campaign on Super Bowl Sunday and of course, during the week leading up to it and other efforts to amplify the cause. You're able, obviously, to track views, but beyond that, how are you measuring the impact?
Well, we have a very scientific way of an interview process where it's over 8,000 people random selected from our group. And they educate us in terms of, these are people who we've had no contact with. It's done very scientifically. And what we learn from that is how we want to proceed to try to continue to educate the American population.
Given your background with the Patriots, I mean, there has been a lot of talk over the years how sports was kind of one of those, you know, unilateral unifiers in this country. You know, of course, we all pick our cities and our teams, but at the end of the day, if you go to a stadium or you go to a bar to watch the games, you're probably the most diversity you're going to see in any sort of stage in your life. And I'm wondering, can it be that again, or was that never the case?
No, I really believe that sports and music those are the two things that bring people together from all walks of life, all backgrounds. Those of us who have benefited by this country have a responsibility to stand up. And I've had a lot of wonderful people contribute to us who want to be part of the effort, because we're just trying to lead and help manage a great group of people that have this on their agenda to fight back and push back against all this hate.
And our thanks again to Robert Kraft for joining us. He's the founder of the Foundation to Combat Anti-Semitism, of course, also the owner of the New England Patriots. And it goes to the point that the NFL has been pretty vocal in terms of talking about anti-hate. They had this end racism messaging in the end zone for the last couple of years. This year, they're changing that to choose love. They started doing that in the later rounds of the playoffs.
Yeah, it's interesting. I mean, what you heard Robert Kraft talk about there, which I think it cannot be emphasized enough, is people listen to sports figures and entertainers probably more than anyone. And so the recognition, you know, you see Snoop Dogg and Tom Brady, these are two of the most famous and influential people in the world. People pay more attention to the Kansas City Chiefs because Taylor Swift is a big fan because her boyfriend plays on the team. And, you know, you think back to 2020 and LeBron James coming out the way that he did around certain social issues. They have a platform that, if they use for good, can be extremely influential.
And can be instantaneously effective as well. I mean, people are going to be talking about these ads. In fact, that's why they roll it out a week in advance to kind of build up the interest for it.
Totally.
All right, still ahead, we're going to talk about the rising popularity of sports betting with FanDuel's CEO Amy Howe. This is The Close on Bloomberg. The Super Bowl is traditionally the biggest betting day in the U.S. Americans are expected to place an estimated $1.5 billion in legal wagers on Sunday's matchup between the Kansas City Chiefs and the Philadelphia Eagles. I had the chance to catch up with FanDuel CEO Amy Howe, and she told me about how her company is planning to capitalize off of the $15 billion sports betting industry. Take a listen.
The Super Bowl is always the biggest sports betting day of the year, and this year will be no exception at all. From a handle perspective, it's actually pretty even. A slight edge towards the underdogs. The Philadelphia Eagles have about 52% of the handle. A bit more skewed when you look at the bet count, but where the real excitement is around the player props, right? You got Saquon Barkley, who is the odds-on favorite for MVP, and of course, all the usual suspects: Mahomes, Jalen Hurts, Kelsey for anytime touchdown scores. One of the things that we have at FanDuel this year, which we're very excited about, is a new product called Your Way, which is live in all the sports betting markets that we compete in. And it effectively gives consumers unlimited choice and control. So, you might go into the FanDuel app and see Travis Kelsey receiving 60 yards or so. You can toggle that and it'll reprice the market, and you can parlay just about anything you want. So we're very excited about that for this year, which gives you lots of different options to bet on this year.
So basically, it allows people to customize their bets. So are there a lot of new markets created during the course of the game that people can then bet on?
Yeah, that's exactly right. So, you can, any player prop, you can customize, you can actually increase or decrease the line and it recalculates the odds. But there's also some great head-to-head markets, which are really popular. Mahomes to pass for more yards than Hurts, and then you can parlay those. And so what you're seeing is a lot of creativity, right? You've got, 20-leg parlay bets that consumers are going in, and it is your bet. So we're very excited about it.
This is expected to be a pretty close game, as implied by a smaller than average point spread.
Yeah.
I know that there are some 600 separate markets that people can bet on. Can you give us a sense of which ones are unique to FanDuel that only you offer?
Well, there's specials that we offer every year. So we've got a jackpot for $5 million. This year we've had a special that was popular throughout the entire NFL season, which is each team to score a rushing and a passing touchdown in each half. So that one's really popular. But probably the most unique thing is this Your Way product. What we also have this year is we have brought back the Kick of Destiny for the third year. And this has really kind of become part of the Super Bowl. So we have Eli and Peyton Manning, who are going to compete in a live kicking competition on Sunday at 3 o'clock Eastern. Consumers can go into the FanDuel app and they can decide if Eli or Peyton is going to win. And if you choose correctly, you get a share of $10 million of bonus bets. So that you certainly can't find at any other sportsbook app.
Yeah, building off the Manning brothers franchise and brand that they've really built up. The American Gaming Association forecasts a record $1.39 billion in Super Bowl bets this year, which is just kind of mind-boggling. Can you give us a sense of what FanDuel's share of that would look like?
It's hard to predict what our share of the Super Bowl is going to be. If you look at our share over, these are numbers that we shared at our investor day. We've had about a 45% share of the market. Those numbers are going to bounce around a bit, but we have not just sustained but really strengthened our leadership position over us. If you go all the way back to 2018, when the Supreme Court repealed PASPA. So we've had a great position. We've got a phenomenal product this year, and so we're excited to see. It's one of the most important days of the year because we're also bringing a lot of new users onto the platform, and it's an important way for us to educate consumers as well as we do that on how to bet responsibly. So it should be a great day. We'll see where the numbers fall out.
Well, security, we know, will be stepped up in the city of New Orleans following the New Year's Eve attack in the city. Do you see that translating into fewer visits by people to the city and therefore an increase in terms of mobile bets?
It's hard to say. I don't know the actual visitation numbers. Just being in the city of New Orleans right now, it's certainly bustling. I don't think it's going to have a huge impact on the numbers. We're live in 24 states, which is over 50% of the U.S. population, and Super Bowl is by far the most important betting day of the year. But it's a great way for new users who are big NFL fans but may have never had an opportunity to bet before. It's a fun way to do it, and it's a very social, engaging way to make the Super Bowl, which is already fun, even more engaging.
And that was my conversation with Amy Howe, CEO of FanDuel. And Jason, it is really interesting to think about how, like, maybe 5-10 years ago, sports betting was not as prominent. It was not even prominent. And the only way you really bet on sports, the Super Bowl, was like those squares that you bought, through your office colleagues.
Oh yeah, you would show up at the Super Bowl party, and like somebody's kid would be running around and be like, fill in this box and give me $5, and you're like, okay. Or if you were really into it, you'd have to literally like call your bookie.
Yeah.
I mean, it's crazy to think about how much the public has embraced it, but also how much the leagues themselves are like all in all of this content that is built around the lines.
Their
It's
entire
insane.
show is built around this, right?
Yes.
And Adam Silver was the first sports commissioner to start talking about it as, like maybe we need to think about this in a different way.
Yeah, it's crazy. But it also speaks to how deeply embedded sports and this game are in the culture, right? I mean, this is in a world where we aren't always watching the same things. We're almost never watching the same things. Everybody knows about this game.
You can't afford not to watch this game because that's what everyone's going to be talking about. And you don't even have to like the game or know the players, but you got to know about the commercials. You just need to be able to take part in the conversation that happens the following day.
And you wonder why these teams are worth billions and billions and billions of dollars and growing? This is why, because people are tuning in. Those media rights are huge. The ticket prices go up. So there's just money everywhere.
And they can't add more teams without changing the math of how many games they play and how many teams make the playoffs. So it's really a very, very limited supply.
It's amazing drama, and we're all going to be tuning in.
All right, well, that does it for us. My thanks to Jason Kelly. Of course, he is the co-host of The Deal with Alex Rodriguez and Jason Kelly. This airs, every week, right?
Every week. Tune in.
All right, we look forward to that. In the meantime, for more sports coverage, also listen to the Bloomberg Business of Sports podcast every Friday, Saturday, and Sunday on Bloomberg Radio, where we explore the big money issues in the world of sports. And every once in a while, we do that on the close here as well. Have a great weekend, everyone. Hope you enjoy the Super Bowl, whether you watch it live or whether you watch it on television or you stream it. This is Bloomberg.